Hello and welcome to Portfolio Matters. We've been away for a week, and in the last 2 weeks, all hell has broken loose. So we will go through it. Richard will first read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. What do we have this week, Keith?
Right. Well, it's been a very busy couple of weeks. The world has changed. So Donald Trump survived an assassination attempt and his popularity increased. Joe Biden finally decided to step out of the presidential race to be replaced by his vice president, Kamala Harris. And she has closed the gap with Donald Trump. Donald Trump is still well ahead in the polls. Be very afraid. But let's see how she gets on as the US public gets to know her. Equities have had a very volatile couple of weeks. The Google actually beat expectations, but the market still took it badly. Tech has corrected downwards sharply. The Russell 2000, however, small caps in the US, has done well as the falling interest rate expectations in the US have led to anticipations that small caps will do better. Commodities have suffered sharp falls. We will take you through the data, but copper, aluminium in particular, and oil all suffered sharp falls over the last couple of weeks. The commodity markets seem to be concerned about global growth. The data, US GDP came in hot. UK inflation came in on target, unchanged at 2%. Now, Rachel Reeves is expected to reveal a 20 billion black hole in the government finances when she gives a speech on Monday, and she has previously talked about giving UK public sector employees a 5.5% pay increase, all of which would be bad for UK inflation. Now, China has had weak GDP figures and has started cutting rates. Some charts related to news. Well, this is the odds of Donald Trump being the next presidential candidate. I read a summary of his proposed agenda for the next presidential term if he should win, and it is quite frightening. In particular, he'll attempt to politicize the civil service, and that would be very bad for US democracy. Now, so far, the falls in the S&P 500 are just noise. Let's see if this develops into anything further. And the fall in equities has come despite most US companies actually beating earnings forecasts, although the rate at which they're beating revenue forecasts is falling. And the Russell 2000 has done well as the NASDAQ has fallen. Moving on to China. This is China's prime loan rate, and it's been cut to a record low. We'll take you through the China data in due course. So moving on to economic data, quick summary. UK is resilient, but not growing strongly. The EU is stagnant and actually showing signs of further weakening. The US is strong, with some signs that the rate of growth is slowing. China, the latest data shows the Chinese economy is weak. On to the UK, Richard.
Thank you, Keith. So UK average weekly earnings have, they're sort of rising almost at 6%, aren't they? Which is not good news for the overall inflation prospects. And although they're down a little bit at 5.7%, it's still pretty high.
That is not consistent with a 2% inflation target. wage growth needs to get back to 3% minimum. Sorry, maximum.
Yeah. So excluding bonuses, actually the figure's really very, very similar, 5.7%, and much too high.
So I've downloaded the ONS data, and you can see the table bottom right is the annualized rate from the including and excluding bonuses numbers. So 1 month annualized rate, including bonus, so total wages is 3.5%, which is reassuring, but excluding, so regular pay, is still at 6%. And look through the chart, not very reassuring in any time period.
Interesting. So this shows that real wages are rising, average weekly earnings. It's not surprising real wages are rising, because real wages took a real hit.
Yeah.
When inflation was above 10% in that period. So in fact, what's happening is they're sort of playing catch up.
Yeah, but real wages are rising higher than inflation. In order to stop demand rising and creating more inflation, you need to either keep interest rates high or you need to raise taxes.
Yeah. Well, I think the latter is quite on the cards, isn't it? The public sector wages are rising faster than the private sector. And clearly the public sector is looking for and likely to get, I suspect, around about a 5% increase.
Yes.
In the near future. And this shows that pay growth looks to be set to drop below 5% for the first time since 2022, month on month, according to Bloomberg. So this is sort of a very current data.
Yeah, now Bloomberg take that data from the ONS. Now the data I've shown you, which is total pay, does not show that.
No. This is slightly contradictory, isn't it, Keith?
Well, presumably that includes public sector pay, which is higher. But, this is good news. But, if Rachel Reeves raises public sector pay by 5.5%, that does not help the fight for against inflation. And reminder, the Bank of England actually meets next week. So Bloomberg is saying that last time the Bank of England met, the decision whether to raise rates was finely balanced, and that the Bank of England is likely to cut rates next week. Now, given the persistent wage inflation and Rachel Reeves promising public sector 5.5% pay rises, I don't see how they can.
I know. They have this. There's an inherent conflict there, isn't there?
Yeah.
It'll be interesting to see how they try and resolve it. UK unemployment rate is definitely increasing, but it's not increasing particularly quickly.
Yeah, and a recession occurs when you get a feedback loop.
Yeah.
So, and that's just not happening either in the UK or the US.
HMRC payrolls changed. So May was revised up, wasn't it, Keith?
It's always revised. I don't know why they just don't report it with a 1 month lag.
Yeah. So 15,000, neither here nor there, isn't it?
Yeah. So I don't see how these numbers are compatible with the numbers for employment change, which showed big drops in employment change over the last 3 months.
Yeah.
Here.
And there we are. Yeah, so that's the 3-month unemployment change, which basically is showing significant unemployment in the last 3 months, and minor gain in employment this month in May.
So, if you look at the HMRC, there's been steady gains throughout the period, whereas here you've lost like 180,000 jobs in the 3 months to March.
You would expect HMRC to have accurate data. I don't really understand why they haven't, because they've got real-time reporting. So I don't get why they find it so difficult to report it accurately. Well, there may be some complex technical reasons. UK CPI month on month, 0.1% in June, annualizes at probably about 1.5%.
Yeah, that's a good number. Now, going forward, the July last year, the month on month was minus 0.4%. So unless July comes in at minus 0.4% or below, inflation is likely to rise when
Yes.
July numbers are reported.
Good point, Keith. UK CPI year on year shows that really sharp upward spike, which has now been almost entirely reversed.
Yeah. Inflation 2% again in June.
Core CPI month on month was 0.2%, which is worse than expected. And your corporate CPI year on year is at 3.5%, where it was in May as well.
Yeah.
But it's still on its downtrend.
Yes, but too high.
UK RPI year on year is 2.9% and has in fact effectively reverted to where it was pre-inflation spike.
Absolutely.
This is a comparison of the various different the CPI goods, services, and CPI excluding energy, food, alcohol, and tobacco, and it shows that the high one is still services at 6% or so. Restaurant and hotel inflation is quite high.
Yeah. It was the biggest contributor basically to the miss in inflation.
Well, in June, hotel prices are up 0.9% month on month. This shows a really sharp increase in hotel prices from, of not far off 40% since the beginning of 2024.
Yeah, no,
There's obviously some seasonality in it, isn't there, Keith? But
yeah, but pre-pandemic, you're talking about over a 50% rise.
Yeah,
that is a shocking number.
Yeah, I mean, more, almost not far off an 80% rise, I guess, pre-pandemic. I have noticed that hotels are much more expensive.
Yeah, so have I. But actually, over the past year, I don't think they've risen anymore. My humble experience. The rise in hotel prices is quite surprising, given that Whitbread, which has a 10% share in the UK hotel market, actually its room rate is down year on year by 0.6%. So FT Alphaville have dug through the original ONS data, and there's actually, this is all their data. They don't sample that many hotels. And the rise in June hotel inflation is down to just 3 hotels. And that appears to be Taylor Swift. So the price of hotels near to Taylor Swift concerts trebled. And that should come back down. So she did have a small effect on UK inflation.
The Swift effect.
Yes.
Housing saving ratio is climbing again, actually, having had that artificial peak during COVID. It's climbing back up to above 10%.
Yeah, I'm surprised, actually. I thought UK households were very stretched.
Well, maybe they're starting to benefit from the pay rises coming through, Keith. And service inflation fell in June if you exclude volatile items.
Yeah. So, if we exclude Taylor Swift, that's it's come down, but still nowhere near enough, I'd say.
It's on a gentle downtrend, isn't it, Keith?
Yeah, and the bottom line is that the Bank of England were forecasting it'd be at 5.1% now, and it's not. It's at 5.7.
We haven't had one of those Bank of England inflation projection graphs recently, have we?
We had one in May. When the next one comes out, I'll put it in.
I always like to have a good laugh at those.
Exactly.
UK retail sales month on month down a little bit in June. Have had a good month in May. So sort of just eyeballing that histogram, I would say flattish, wouldn't you, Keith, over the last 12 months?
Yeah, well, here you go, year on year.
Yeah.
Good mental calculation there, Richard.
Thank you, Keith.
Absolutely flattish.
Precision, verbal precision.
Yeah.
UK consumer confidence is actually continuing to rise steadily and quite steeply, which is also good news for the economy.
Yep.
And UK public sector borrowing, excluding banks, was for 14.5 billion in June, which was more than expected, less than in May. But we are a highly indebted nation.
Yeah, and Jeremy Hunt, those two national insurance tax cuts he did earlier this year, just totally fiscally irresponsible. And now Labour are saying they're not going to raise national insurance or income tax. Well, they should. Those two tax cuts were just utterly irresponsible.
Well, I think what we're seeing coming out in the wash is what we all knew viscerally, isn't it? That the Tory government was grossly incompetent.
Yeah.
And I say that as not a socialist, but they had a degree of incompetence that was just entirely unacceptable.
Well, they were obsessed with short-termism.
Yeah.
Those cutting taxes try and get a short-term boost in the polls when, it was never going to work.
Short-termism, but also just not doing things properly.
Yeah.
I mean, everything done for the wrong reason.
Yeah. Well, exactly, Richard.
Global, I'll just step off my soapbox now. UK S&P Global Manufacturing PMI in July, 51.8, so better than expected. And we have got a little bit of an uptrend running there, which is also good, although it has yet to get back to those pre-COVID levels of about 56.
Yeah, I would caution, though, that, we know the PMIs are a very poor guide to actual activity, and the CBI numbers coming up are bad.
Okay, UK S&P Global Services PMI, again 52.4%, and slightly below expectations, but about an average figure, really, Keith, aren't they?
Yeah, absolutely. It shows the UK economy doing just fine, actually.
Yeah, and the composite PMI is doing likewise. The CBI business optimism, not looking too good. It was looking okay the previous month. Now it's not looking okay. Quite a sort of large shift. Is that to do with the general election, perhaps?
I don't know, but if you look at this, that's not good.
No, it's not, is it? The CBI industrial trends orders minus 32 in July. It's a very noisy chart, but it really needs to be rising from its current point, not fluctuating up and down around that sort of midpoint of where it is.
Yeah, and this contradicts the PMI, which seems to show things improving. Well, that's not a good number.
No. UK car production is sort of oscillating around its new normal post-COVID average of 68,000.
Yeah.
And the economic surprise index is actually looking quite healthy at the moment, Keith.
It is. UK economy is surprising in its resilience.
Indeed, job postings, I would say that this line is now leveling off, that the Indeed job postings index is flattening out.
Yeah, I think you can say that. But, I mean, we've been here before. How much of this is seasonal? Don't know. Similar pattern, in 2023.
And the wage growth on the Indeed jobs postings is 6.9%. Let's call it 7%, which is high.
Yeah. Now, once again, they've revised this, though, in a way I don't like, because previously the May number was 7.
Right.
And now, they've clearly revised that.
Yeah. Office of National Statistics online job openings data, which seems to show that the UK labour market is weakening, actually, a little bit, but it's not problematic at this level, is it?
Yeah, and you're not getting a feedback loop whereby job losses are causing companies to really pull back, but it is below pre-pandemic levels.
Yeah, and for a strong economy, that line needs to be turning back upwards.
Yeah.
that is the task of the Labour government, I guess. Number of potential redundancies in the UK, it's not rising. In fact, it's falling. So clearly, employers are not feeling pressurised.
Yeah.
And aggregate spending on debit and credit cards is actually down 8% year on year.
Yeah, I thought this was a surprising number, actually. I'm sorry about the resolution of this chart. It's from the ONS, actually.
So this is our summary. And the UK economy is actually showing some signs of resilience, and potentially it's going to turn around now and start to grow again properly.
Well, if we can get inflation under control and the Bank of England starts to cut rates, then you can see we've achieved a soft landing.
Yeah.
But reminder, interest rates are currently 5.25%. And when inflation was spiking, the Bank of England was in two minds whether to raise from 5 to 5.25%. So they thought it might be over-tightening. Well, the over-tightening hasn't really slowed down the UK economy very much.
Yeah. And we still do have a lot of fixed rate mortgages coming off over the next 2 to 3 years. And that will have a negative impact on the economy.
Yeah, but the thing is that the Nationwide have now cut their 2-year below 4% just. So most people who are coming off will be around 3% to about 4%. So it will have an effect, but it's not going to be enormous.
Yeah, that's true, Keith.
Okay, on to the EU. So we had industrial production numbers for May, and they were poor but better than expected year on year. EU manufacturing is still not doing well, down 2.9% year on year. Construction output was awful, actually, down 2.4%, well below expectations. The April number was revised down. And higher interest rates in the EU are definitely having an effect on the construction market. Economic sentiment having improved very sharply over the last few months, took a leg down in May, but actually that is still a good number. Consumer confidence, just like in the UK, is climbing back. And actually, given Europeans are always miserable, that is getting towards mean, I would say. The PMIs, that is a very bad number, that 45.6, down on consensus and below June. So EU manufacturing just not recovering. Services also weakened in July. Not great. So that meant the composite was back down to 50.1, i.e. neutral, barely expanding, and well below average. Loans to companies, though, have picked up. Loans to households were disappointing, but have picked up, and the money supply is growing again. But the EU economy is surprising to the downside once again, having surprised the upside for the first part of the year. And the Indeed job postings confirms that the jobs market appears to be weakening, although wage inflation remains higher than the ECB would probably like. The sharp drop in French job postings around the elections appears to have stopped. Wage growth in France, that will reassure the ECB. Actually, that is a poor number and it's falling. And thank you to Jaw It for sending us this. This is the electricity demand in the EU. And you can see it's fallen quite sharply this year on year, down 7% in, what's that, March, down 3% in April. That confirms a weak EU industry. So EU summary, well, the EU economy is not doing well, and the latest data appears to show it is weakening once again. On to the US, Richard.
Thanks, Keith. So GDP quarter on quarter annualized, 2.8%.
Yeah, now that's a good number, but part of that was due to Boeing, actually. And so Boeing orders are very lumpy. And so some of its deliveries were moved from Q1, which was bad, into Q2, which was good. Actually, if you take a sort of average of the two, that's probably more accurate, and it shows the US economy doing just fine. Thank you very much.
US PCE prices quarter on quarter, 2.6% annualized, lower than expectations. Still sort of, they had a bit of a blip up, but we're going back down now. So we shall see whether that persists. And PCE quarter on quarter annualized, 2.9%.
Yeah, sorry, that's core, Richard. And the commentary is this was a miss. And we have US June PCE inflation data out later today, and this miss implies that will be hot.
Real consumer spending up 2.3% in the second quarter, so annualized at 2.3%.
Yeah,
reasonable growth.
US consumers remain resilient.
Yeah. US durable goods orders, big fall in June, but I guess, as you say, Keith, it's a very lumpy sort of number, isn't it?
Yeah, it's all transport.
Yeah. Manufacturing new orders do look as if they have reached a peak. In fact, they've fallen quite sharply from where they were a couple of months ago.
Yeah, so if ignoring the noise of this month, it just generally seems they are lower than they were last year.
Durable goods ex transport month on month, which is less lumpy, up 0.5% in June.
So better than expected, actually. So,
And US retail sales month on month, unchanged in June, excluding gas and auto. So it's up 0.8% in June.
Yeah, that's a strong number.
And US retail sales year on year, up 2.3% in June.
Yeah, so, all resilient.
Yeah. Industrial production month on month, up 0.6%.
Very good.
Industrial production year on year is up 1.6%. It looks like it's climbing. And manufacturing production month on month up 0.4%. And year on year, manufacturing production is up 1.1%. So it's all looking quite healthy.
Yeah.
The Michigan Consumer Sentiment Index, which is, this is a very long time frame. So it is hard actually to interpret, I think, what's going on here, Keith. What do you think?
Well, consumers, that is a bad number in absolute terms. But we've talked about how there seems to have been this systematic step down in consumer sentiment post-pandemic, which makes these long-term comparisons rather difficult. But month on month, you can say that consumer sentiment seems to have taken a bit of a knock off over the last 3 months.
And the consumer expectations in July also falling back. Current conditions actually fallen quite sharply, and it's at one of the lowest levels it's been since this series started in the 1970s.
Yeah, now this is really interesting because actually when you look at retail sales, industrial production, etc., they're all fine. So why do US consumers think that current conditions are so bad? It's odd.
I guess part of it, it can't help but be conflated with the political situation, can it?
Yeah.
And the tension in the country.
Yeah.
US 1-year inflation expectations dropping to 2.9%. And 5-year inflation expectations at 3%. They never really grew terribly much, did they, Keith?
Yeah. No, the central banks retain credibility.
Yeah.
The same.
And this is the consumer survey revealing that a significant proportion of its respondents are in fact expecting hyperinflation.
Yes. So if they report the median, but if you take the mean, it goes to 6.1. So that implies there are quite a few
A few
respondents.
people saying 10,000 or something.
Exactly. Yes.
US manufacturing PMI 49.5, so just dipped below the negative.
Yeah. But we've just seen that June numbers were absolutely fine.
Yeah, and services PMI is rising and looking quite strong there.
Yeah, that's a good number.
This graph shows that we've got this big divergence in recent years, recent months, between the ISM and the non-manufacturing PMI, and whereas they were fairly constant in relation to one another, and now they're diverging from one another, which suggests something has changed in the statistics that are being gathered.
Yeah, we've talked about this before, but this divergence is extraordinary. And the
Yeah.
non-manufacturing does include um, mining and oil production. So it does what it says, anything non-manufacturing, whereas ISM, so the S&P Global Services just looks at services company, but still, the extent of the divergence is really extraordinary.
Yeah.
And if you look at these two charts, they are the forecast for US service consumption based on either on the left, the S&P numbers, and so they're forecasting quite strong US services consumption, whereas right, based on the ISM non-manufacturing, you get very weak numbers. So which one is more likely to be correct? Well, historically, the ISM has been more accurate. And actually, the S&P services, the correlation between actual activity has been absolutely terrible. No correlation whatsoever.
Yeah.
But more recently, you'd have to say that services consumption in the US has been absolutely fine, and the non-manufacturing has been saying it would be poor, and it hasn't been. So, who knows?
Yeah. So this is a US composite PMI, which is looking healthy, as you'd expect from services. The NAHB housing market index is falling.
Yeah, that's not great.
No. US building permits has stopped its recent fall and remains to be seen where it goes from here, though. US building starts seems to have stabilized at around that 1.35, 135,000 unit figure.
Yeah, I mean, that is actually not a bad number in the context of history.
Existing home sales are pretty low, as low as they've been since the late 1990s, actually, and the GFC.
Yeah. And that matters for economic growth because when people move house, they also buy new furnishings, etc., etc.
Yeah.
And, that is a drag on growth.
New home sales look like they've flattened around about 600 to 700,000 per year. The US Empire State Manufacturing Index down. That doesn't look very healthy.
Mm.
The Richmond Manufacturing Index doing the same thing.
Actually, that's a new cycle low. That's a good number.
Sharply down in July and not looking great. The Philly Fed Manufacturing Index, on the other hand, is looking pretty damn good.
It is. Yeah. So, move from Richmond, Virginia to Philadelphia.
The Conference Board Leading Index is the year-on-year change. The leading index is now moving up quite nicely, actually.
It is, yeah.
And the equity market is in agreement with it.
Well, this is one of the components. The reason it's positive is the equity market's doing so well. If you look at all the other components, nicked so good, frankly.
Yeah, that's true. Yeah. And so that Conference Board is no longer forecasting a recession. It's just nicked above the recession line.
Yeah. So, that recession forecast, which frankly has never got wrong before, and which I believed as well, just didn't happen.
So the Chicago Fed National Activity Indicator is slightly positive.
Yeah, so the US economy in June, according to Chicago Fed, was operating just above average. So again, US economy resilient.
Red Book retail sales up 5%. I mean, we've had other retail data and consumer spending data. This is a bit higher, but it's all consistent.
Well, this is nominal. So, seems fine.
Yeah. US jobless initial claims is looking okay. Very stable, really. Continuing jobless claims a little bit higher than it has been in past months, but not looking problematic.
Not accelerating.
Yeah. And the Dallas Fed economic GDP estimate is at 2.2% this week, 3.0% last week.
Yeah, well, 2 weeks ago.
And the New York Fed GDP nowcast is saying 2%.
Yeah. So again, the US economy, it's down from, 2.5% earlier in the year, but it's doing absolutely fine.
Yeah. And the St. Louis Fed is saying 1.14%. So they're all positive.
Yeah.
But actually, surprisingly, with all of that lot going on, the economic surprise index is rather negative.
Yeah. Well, people are expecting it to be stronger.
Job postings index on Indeed looks again like it's sort of flattening out.
Yeah, it's the last couple of weeks, actually. Small pickup.
Yeah. Indeed. And the wage growth on that index is flat now at 3.1%.
Yeah, and that is pretty much consistent with the 2% target, actually.
Yeah. So US truflation, about 1.8%, fallen quite sharply from a few weeks ago. Paycheck Small Business Employment Report suggests there is a continual slowing of the US employment market.
Yeah, interesting.
Yeah. And the huge US budget deficit is not buying enough GDP growth. So the red line is where GDP increases match debt increase. And for the last decade and a half, that level has been, the level of debt is too high to get a one-to-one or better relationship.
Yeah. The non-farm payrolls, which we talk about every month and have been consistently strong, and we've been consistently skeptical about whether they are accurate or not. Well, every quarter they are re-benchmarked back to the consensus data, and the latest data is for Q4 last year, not Q3, and it shows that the actual figure for number of jobs created was 264,000, whereas non-farm payrolls reported 637,000. So non-farm payrolls was well over double what the actual job creation was. And reminder, the non-farm payrolls, which is the pink line, has been showing steady jobs growth in the US, whereas the household survey has not. And the household survey has been showing actually a lot of those jobs are part-time jobs, and full-time jobs have been falling.
So household survey, you would think is going to give a much better figure. We've discussed this in depth, haven't we, Keith? So there's a dichotomy there. So here's our summary. Bottom line, the US economy appears to be remaining strong. And the recession that Keith and I have been forecasting doesn't appear to be emerging, does it, Keith?
No, it doesn't. And actually, it looks like if the Fed now is in a position to start cutting rates, then they could have achieved a soft landing.
Yeah.
And on to China. Now, we had all the data from China was weak. So this is loan growth and is absolutely collapsing. The lowest it's been since records began, certainly for trading economics. Prices for newly built homes in China fell 4.5% year on year in June, and that's a significant deterioration and not good. Retail sales disappointed at 2% year on year in June, down on May and well below expectations. Fixed asset investment is 3.9%, down on May. The unemployment rate, if we believe it, unchanged at 5%. GDP growth in Q2, very disappointing, down to 0.7% quarter on quarter, well below Q1 and below expectations. Year on year, 4.7%, below target. And the falls in the Chinese property sector, as we have warned previously, undermine the finances of Chinese local governments, which rely on land sales to fund themselves. And so local government deficits in yellow are really bad, and they're now relying on the central government for financial support. And this is why revenue from land sales has fallen. And if property prices keep on falling, then that's going to get worse. And this is really interesting. China, the tax revenue as a percentage of GDP has been falling. They need to raise taxes. And further evidence of weakness in the Chinese property sector can be found in the share prices of property companies listed in Hong Kong. And their share prices have had a terrible time. So China is cutting rates, and this is the 10-year yield, but monetary policy is ineffective if you have excess capacity, and you've got excess capacity in the property sector and arguably in the industrial sector as well. So who wants to borrow to invest? Monetary policy becomes ineffective. So bottom line is Chinese economy looks weak. And onto one chart. So we've been talking about this in the context of resilient US economy, but the stock market has been supporting US consumers, and the green line is the number of people surveyed in the monthly Michigan survey of consumers who have stock market investments about worth more than 500 grand. And that is over 30% of respondents. That is a lot. So, they'll have been doing very well from the stock market, and the wealth effect means that they will then have been spending around normally it's about 2 or 3% of any increase in their personal asset wealth in the form of consumer spending. So if the current correction in US stock markets gets worse, that will then start to drag on the economy. We just have to wait and see. So far, the correction in the US stock market looks pretty normal given the run that we've had. Watch this space. Now, as you'll all know, I've got it totally wrong this year, expecting a recession and aligning my portfolio for a recession by buying long-dated bonds. And the recession hasn't occurred, and I've got killed. Now, one person who has got it right on our Discord channel is Simon, who relies on technical analysis. And so let me know if you find this useful. If you find this useful, I'll get Simon to do a regular slot on his technical analysis forecasts. So please get in touch via the comment section or on the Discord. So this is Simon's analysis of various markets. Now, on the NASDAQ, and he did this earlier in the week and has been proved absolutely right, He says the Nasdaq has met resistance at the uppermost implied market growth trend line after a strong rally, and the likelihood is of a potential correction of 7 to 10% led by big tech. And frankly, he's been absolutely right. But he adds, all trends are rising. And there's no reason to be bearish unless earnings disappoint. Now, earnings have so far not disappointed in terms of their absolute levels, but it's clear from the reaction of the market to Google that the market was expecting Google to beat its earnings forecast by more than they actually did. So market sentiment, although Google beat forecasts, it didn't beat investors' expectations of its beat, if you see what I mean. The S&P 500, very similar to the Nasdaq, obviously, as big tech is heavily weighted in both. And I'll read this out. The S&P 500 has reached an implied resistance trend line, as well as the end of a 5-wave count from October 2022. So you see A to B, big rise, correction, big rise, correction. He is now forecasting a 6% correction. So far, he's been right, has corrected. Now, the FTSE 100, he's saying that there's this triangle emerging and the FTSE is heading towards the apex of this triangle, at which point it'll make a decision up or down. And actually, when you look at the chart of the FTSE 100, it is going absolutely nowhere. It hasn't fallen. So far, that is playing out. Treasuries, well, TLT, this is the US 20-year plus Treasury ETF, appears to be breaching the top of its recent channel, but needs to reach 94 to confirm that. Now, actually, that hasn't happened. This was done earlier in the week. It's fallen back, but it's towards the top of its channel. So let's see what happens there. And gold. So gold, if gold breaks out of its current range, then it could move to a new channel above 2,600. So it's within this top channel. It's actually fallen back a bit. A sell-off in stock markets could result in gold selling off short-term and maintaining the current channel. So we have had a short-term sell-off in equity markets. Let's see how gold resolves itself in the coming weeks. So that's it. Please let me know if you found that useful. Bottom line is, Simon thinks that the correction in stock markets is perfectly normal and does not see a bear market as yet. Onto the US labour market. Richard.
Thanks, Keith. Interesting few charts from Simon there.
Yeah. If people find them useful, we'll do it regularly.
Yeah, thank you.
Let's face it, he's been a much better guide to things than I have. So, you know.
So this chart is showing that the number of job openings to the unemployment rate has fallen from 3 to 1.2 over the past year. In other words, if you're unemployed, it's getting harder to find a job. And if that continues, you would expect the unemployment rate to start to rise.
Yes.
Having said that, the non-farm payrolls has continued to grow, and the job openings have now actually slowed to pre-pandemic levels, which puts them back to sort of roughly where they would have been had we not had the pandemic. So jobs market's normalized. Is it going to proceed beyond that normalization, or is if it's a soft landing, it will stick where it is? If it's a hard landing, you would expect to see the jobs market becoming more difficult. And we're sort of on the cusp, really, aren't we, Keith?
Well, what this chart shows is that this has been an extraordinary period in that, normally when you get a peak in the job openings, you get a fall in employment thereafter, and it just hasn't happened.
Yeah, I don't think I'd say though. So those falls are quite long term, aren't they? They span those curves of 2000 and 2008. They span several years, and we could easily we could get, I mean, I take your point in that it's not contemporaneous, but we could still get a fall in that red line.
Yes, I agree. Completely agree.
And this showing that continuing jobless claims have reached a high since the year end of 2021, with initial jobless claims also rising. So this is suggesting that the US jobs market is actually not in a terribly healthy place.
Mm.
So we have got unemployment rising, and the SARM rule is actually approaching at a recession indicator point.
Yeah, we talked about this before. We don't think the SARM rule is going to be accurate this time because a lot of the increase in unemployment is due to new people entering the labor force and not finding a job, as opposed to people being laid off.
Yeah, and also historically, when you look at those, it goes up through that threshold quite quickly.
Yeah,
and
it's just not happening.
It's not happening. Yeah. So household survey showing that only 16,000 jobs were added last year. The establishment survey saying 1.3 million. And the difference is suspected to be mainly part-time jobs.
Well, the difference I think is largely due to the births and deaths model, in the establishment survey, which we don't like, but we've talked about this many times.
Yeah. Falling wage growth suggests that demand from employers is falling, which is true. So this is all suggesting that the labour market is slowing down, but it's not necessarily taking the US into a recession.
Absolutely.
And the question then is, will the Fed feel free to cut interest rates? So we've got what the stock market has done versus what employment versus Fed policy, and the linkage actually between the two has broken down, hasn't it? Well, the historic linkage, I should say.
Yeah. Well, what this shows to me is that, in order to get a stock market downturn coincides with falls in employment, which we just haven't seen.
Yeah, that's true. So we've got no pickup in layoffs, and typically recessions coincide with a pickup in layoffs. So that's suggestive that there's not a recession around the corner. We look at that number. What's that indicator called? It's a theft or something or other report, don't they?
Yeah, the warn.
That's warn notices.
Yeah. Warn notices, we actually have warn notices coming up. Warn notices are picking up, but from very low levels.
So the US labour market is slowing, cooling off, and it's not to the point where the recession is indicating there should be a recession. So there's just a slowdown. So the US economy is slowing.
Yeah,
but it's still fine.
It's still fine. Another point, let's talk about lumber, because what's happening in lumber has implications for the US labor market. So lumber prices have collapsed from their post-pandemic highs, and inflation adjusted, they're terrible. So I listened to a podcast this week talking about the lumber market, and lumber prices have been below production costs for much of the last year. Demand for lumber, 50% comes from remodeling and refurbishment, around a further third from house building, and the remainder from exports and other. And part of the reason there's been a big drop in lumber demand is that remodeling and refurbishment, that demand was pulled forward during the pandemic so all those stimmy checks, people stuck at home, what they did was they worked on their homes, and that remodeling, once done, is not going to be done again. So what the stimulus checks did was they pulled forward remodeling demand, and there's now a lack of remodeling demand. For the supply side, prices have been below break even for most of the year, but lumber producers continue in operation because they're reluctant to reduce staff because they fear that if they let staff go, they won't be able to rehire them in a way. So the experience of the pandemic is causing employers to hoard labor. And so you can extrapolate this to the rest of the US economy. Fears of a tight labor market are causing labor hoarding, which in turn contributes to a tighter labor market. So if that were to change, if you started to get layoffs and the unemployment rate started to rise, it's possible to see you would get a feedback loop whereby lumber mills, etc., felt able to then cut back on their staffing and reduce unprofitable production.
So, okay, so we'll have a little look at UK truflation. Truflation in UK year on year is saying the rate is 0.63%. UK government is reporting an inflation rate of 3%. So why is the truflation figure so different to the official figure? We don't actually know how truflation is calculated in the UK, but in the US, the methodology relies on online prices. So the data collection methods are shown in this table here. So for truflation in the US, they collect sales price data, 13 plus million items per day. And once a year, they update the relative importance of the various components using previous year's data.
So, I mean, this is really interesting. So, you're using live data from the internet to give you an idea of what consumer prices are. I mean, this seems, quite sensible, frankly.
Vast quantities of it as well.
Yeah, vast quantities.
Yeah.
So this is, sorry, Richard, this is all UK data.
Yeah. Right. Okay. So so this is UK data, and we've got food and beverages. The truflation figures dropping from 10% August last year down to just above 0%.
Yeah. Notice the sharp price falls, inflation falls in July. That's very reassuring.
Yeah.
I like that.
Housing is showing actually pretty much zero inflation, has been slightly negative in the last few weeks. Transport is showing just above zero, where it's been for basically quite a long time. It's low.
Yeah. So I was skeptical about this because see the public transport is negative.
Yeah.
I was skeptical, so I looked at the ONS data, and actually the ONS transportation index does show overall transport inflation is pretty much zero year on year.
Yeah. What you have to look here is you have to try and think, well, in what way is this data gathering method picking up different prices to the ONS method, isn't it? So it's I mean, you could think, for example, this is utilities, it's showing 17-18%. You could say, well, it's not picking up what I pay, it's picking up what I would pay if I were to shift supplier, for example.
True.
So to what extent does that skew it? I don't know, but that was one potential source of difference. Health. So health is interesting, isn't it? Because we have the NHS, the vast majority of people, health inflation is irrelevant apart from prescription prices.
Yeah. That will take you through the weightings at the end, and that's quite important.
Yeah. And I'm not quite sure how you pick up health pricing by scanning in the UK, by scanning the internet for prices, because unless you're looking for supplements and so forth. Household durables, that inflation is pretty high, isn't it? 12%.
That just seems absurd to me. I just don't think you've had 16, 17% inflation over the last year, because goods inflation has been very, very low.
Yeah.
Wonder what's going on there.
Alcohol and tobacco. I'll pass on that one. I don't know that you are allowed. I don't know. Did you get online? How do you pick up cigarette pricing online in the UK?
Presumably from supermarkets and stuff, isn't it?
Yeah, possibly so. Yeah.
But again, the drops in July are quite reassuring.
I'm just curious here, Keith. I'm going to go onto Sainsbury's and I'm going to search for cigarettes.
You're going to Google now bombard you with adverts for Rothmans.
I want to buy cigarettes.
In fact, they know you've got a yacht, Richard. They're going to bombard you with adverts for Capstans, extra strong, filterless.
Okay, so you can, but they do have cigarette pricing on Tesco, on Sainsbury's website.
Yeah.
Benson and Hedges, Super Kings Blue 5 times 20, £64.75. Clothing and footwear is at like 12%, 12 to 13%.
Again, that seems high.
Yeah. RPI of the RPI for clothing and footwear was 6.9%, was almost double actually. The truflation figures almost double.
Okay.
Communications, 5%, but very, very lumpy indeed. I wonder what it's measuring communications. I mean, this is another one where.
That's a good point, Richard. Why is it so lumpy? There are lots of mobile phone providers.
Yeah, and is it picking up deals versus what you pay once you've got yourself on a contract?
Well, this looks like one provider.
Yeah. Yes. Education. I mean, how do you find the price of education on the internet? Because you'd have to make an inquiry of a public school.
Yeah.
Find out what their termly fees are.
Don't know. How do you define it?
Yeah, precisely. How do you define it? Is it educational books? Is it pencils?
Yeah.
Recreation and culture. You can see that's probably fairly easy to pick up in theatre tickets and prices. 12%.
Yeah, but this has, you see, when we go through this, there are quite a number which have high numbers. So how are they getting 0.6% annual inflation?
Food and non-alcoholic beverages are 15.3% of the weighting.
Yeah, so you notice they've got very high weightings to the components that have fallen in price.
Yeah. Also, I mean, health at 8.6%.
Yes. So your point, Richard. I've compared the ONS weightings with the truflation weightings. And, if you look at health, truflation got it 8.6%. The ONS has got it 1.8%. But take a look at this. What's really missing, when we've gone through those components, is restaurants and hotels. Truflation just don't have restaurants and hotels. And when we were going through the inflation numbers earlier, one of the biggest components of UK inflation was restaurants and hotels.
Yeah. And also, if you look at health, Keith, I mean, health is the figure they have for health is 8%. What was the inflation rate for health? It was high, wasn't it?
Yeah.
But people in the UK don't buy health, and it wouldn't really be in the RPI index.
Yeah. So
it's in there at a very low level.
So this is restaurant and hotel inflation, which is a big component of UK inflation. So we've given up reporting UK truflation. And frankly, having gone through that, what do you think, Richard?
I think it was not telling us the truth all the way through because the weightings aren't right.
Yeah.
And the way it picks up some of those numbers must be really quite strange.
Yeah.
Not lined up with the UK.
Yeah. So bottom line, we're not going to report it. It's odd. Not reporting. You'd have thought you could get hotel numbers, data online. Why aren't they reporting hotel inflation? It's weird.
Yeah.
And on to Inflation Watch. So over the last 2 weeks, we have had UK numbers. UK CPI was flat, unchanged at 2%. Core still at 3.5%. still way too high. But given that UK interest rates were 5.25%, real interest rates in the UK are rising. We also had Japanese numbers. Japan actually does appear to have created inflation. Core CPI was at 2.6% in June. Now, reminder that the Bank of England meets next week. What will they do? The ECB met last week and left rates unchanged. They had one cut. So Goldman Sachs echoes truflation, and they think that core inflation in the US is now below 2%. And what is keeping US inflation high, as we've talked about many times, are the lagging components. So CPI shelter remains high. If you exclude shelter, then CPI is at 2% and has been for a long time. And the other components, which are not really influenced by monetary policy, like car insurance, and we've talked about this before, they remain very high, but it does appear to have peaked, and that is driven by changes in driver behavior. There are more crashes due to distracted driving, the impact of people looking at their mobile phones while driving. And so if you look at US inflation and split it into components that are responsive to interest rates and ones which aren't, you'll see the responsive components have responded to higher interest rates. So US inflation looks under control. UK inflation is also falling, but core inflation remains too high. If Rachel Reeves decides to raise public sector pay by 5.5%, then UK interest rates will need to stay higher for longer, unless she also reduces the spending power of those wage rises by increasing taxes, which they're pledged not to do. But I would argue that the two Tory national insurance cuts were just totally irresponsible and should be unwound. Recession watch, Richard.
Thank you, Keith. So the yield curve in the US is uninverting, which is what typically happens on the eve of a recession. So it's a real question. Watch this space, isn't it?
Yeah.
And junk bond spreads are widening. They're not desperately wide, but they are pretty wide.
Yeah, no, that's interesting. So we're talking about the CCC, so the bottom, but that is signs of stress there.
Yeah, and Prometheus research suggesting that US economy is slowing. They've got acyclical and cyclical growth, and the acyclical growth is slowing quite rapidly. Cyclical growth is lower. So layoff rate is rising from very low levels, but it is still at a very low level.
Yeah.
So the S&P 500 versus the S&P 500 equal weighted. When it reaches a peak, you seem to get a recession. Quite often. So it is peaky at the moment. Is that going to indicate a recession?
Well, we talked about this previously, that US consumers are hugely exposed to equities. If we get a correction in the equity market, then consumer confidence is already poor. You can see that further undermining it.
You certainly can. Yeah, our companies are still talking about weak demand, and actually that's quite a high outside of the GFC and COVID. That's a high reading, and the fall in temporary help service employment is continuing and possibly accelerating. So that is a sharp decline, like that has in the past been it's actually mostly occurred during a recession.
Yes,
you look at that with it just starting just before. So that would, if past is prologue, that ought to suggest that the US is in a recession. So I don't think it is.
No.
But
it's
a steep drop. Warn notices, which we discussed a little bit earlier, are picking up a little bit, but they're very low.
Yeah, so they're actually back to basically median,
Yeah,
having been very low.
yeah,
So it all depends on what happens here. You know,
yeah.
from our discussion of lumber earlier, if companies start laying off, you could see a cascade.
Credit card and auto loan delinquencies rising, and they've been rising for a couple of years now. This is credit card balances in delinquency, and 30 plus days past due, but all ages are high, the highest that they have ever been.
Yeah,
And
not good.
not good. Yeah,
Not good. So, we talked about this before. There's Biden's economic policies have these distributional effects, whereas, he's running this big fiscal deficit, interest rates are high, and that affects people with liabilities, which is the poor. The rich have assets.
Yeah. So yeah, the US economy does seem to be slowly, and there is data to suggest that.
Okay, on to soft landing watch. Well, given all the bad data we've just reported, bankruptcy filings, yes, they're rising, but when you look at them in the context, they're not actually terribly high at all. Personal income continues to rise. Travel, very good. Now, in Europe, we've had Ryanair warning that they are no longer have pricing power in Europe, and they've been cutting prices. So what's happened is not that there's been a collapse in travel demand in Europe, it's that airlines had anticipated even more demand than there actually is. And a similar effect seems to be happening in the US. And the US has enormous national debt. And when interest rates are high, it's paying vast amounts of interest to holders of US government bonds. And some of that is likely to be spent, which supports the economy. $900 billion a year in interest is being paid out by the federal government. According to MMT, that means higher interest rates are actually supporting the US economy. And looking at world trade, Taiwanese exports, which are a proxy for global trade, they're doing pretty well. Something we've been warning about for the last couple of years, commercial real estate loans in the US, while the delinquency rate, which was rising very sharply, appears to be peaking. So that doesn't seem to be likely to be the trigger for any financial crisis. And according to JP Morgan, when you look at the global economy, it's doing just fine. We're weakened slightly in June. So bottom line, the global economy, the US economy is doing just fine for now. And Richard, quiz of the week, you're back. So, question for you. Where and when was this photo taken?
Brighton?
No, good guess, but very clue. It's very Belle Epoque, sort of Art Nouveau.
Is it Crystal Palace?
No, it's Argentina.
Argentina.
Yep,
Oh, well,
Argentina, the turn of the 20th century. Argentina then had the same GDP per capita as the US and was one of the richest countries in the world.
wow.
And this point of this goes to show how governance really matters. And what happened in Argentina and why it's important is that essentially it lapsed into populism and dictatorship. And so this is the position of Argentina ranked by GDP per capita in countries in the world. And you see, for a brief period, it was the richest country in the world. But up until actually post-war, it was one of the top 10. And then they voted in Juan Perón and a sort of military socialist program. And you can see the effect on its global ranking. It's gone from top 10, falling every year. Wow. So
that's a cautionary tale, isn't it, Keith?
Absolutely. And on to other charts. So this is residential property prices in Japan. And they have been rising. They've been plateauing recently. But what I find really amazing is that they haven't collapsed, because Reuters were reporting this week that Japan has 9 million empty homes, because obviously the population is now in decline. So, question for you, Richard, why? How come you've got 9 million empty homes, but property prices have been rising? I don't get it.
No, well, I don't either, Keith.
Right.
I really don't.
Okay, good news. Well, good news is cancer mortality rates have been falling. Actually, they've fallen by quite a lot. So when you look at the 1980s, you had mortality rates of about 160 per 100,000 people per annum in the UK, and it is now below 120. So that is more than 25% fall. And the good news is, and that comes despite aging populations, and cancer is disease of the old generally. So that fall is due to better treatment, but also the decline in smoking. And onto equities, Richard.
Thanks, Keith. So the FTSE All World Equity Index had a bit of a hard week, down 3.3%, a hard fortnight.
Yeah, hard fortnight.
Yeah, down 3.3%. The FTSE All Share pretty much unchanged since we last spoke about it.
Yeah, so Richard, SimonW's technical forecast that is going, nowhere, is right. Hasn't joined in the falls elsewhere.
Yeah, that's right. The Euro Stoxx 600, which has been flat for the last 3 months.
Yeah, and this performance of this has been mystifying this year because the EU economy has been very weak.
The S&P 500 has fallen away, as we know, but it's still up 13% for the year.
Yeah, this looks like, so far, perfectly normal correction.
Yeah. The Nasdaq down 6% of late, but up 14% for the year. So, as Keith said, the S&P, a normal correction. Russell 2000 has actually done very well in the last couple of weeks, up nearly 5%, nearly 10% for the year to date. The Hang Seng is on this has been on this downtrend for the last 3 months, and it's continuing that, down 6.8% for the week, and unchanged now for the year. The Topex has had a sharp fall, 6.7% down, still up 14% year to date. Bitcoin basically hasn't gone anywhere since March. It's been quite volatile, but hasn't gone anywhere since March.
Yeah.
And the pound against the dollar, it had a run up, and now it's just coming off a bit. The euro against the dollar actually fairly steady between 106 and 108, 109. Dollar index 104, which is its sort of midpoint where it's been at for quite a while. And the VIX has had a little spike up of late because of the volatility in the stock. Well, obviously because of the declines in the US stock market. So up 43%.
Yeah, but still, but not really particularly elevated at all, frankly.
No. So don't be long in the VIX ETF for longer than a day, because if you are, you lose all your money.
Yep. I did a podcast on this. My worst trade, the iPath VIX short-term ETN. If you're interested in how to lose money by buying a VIX ETF, please read that. Watch that.
and everyone is long the Magnificent Seven.
Yeah.
Fantastic.
So,
And longer.
yeah. So the sharp falls in tech stocks, entirely predictable, as we've been reporting week on week, because everyone was just, limit long.
And the Mag 7 are worth more than any non-US stock market. And their earnings forecasts continuing to rise.
Yeah.
And as long as that happens and they deliver, their share prices will be strong.
Now, but what's really interesting, Richard, is analysts are expecting an acceleration Mag 7 earnings in Q4. Now, and they haven't been talking those down, which is the normal game. So, unless there's this big acceleration in tech earnings later in the year, the market is going to be disappointed.
Yeah, so it's interesting. I mean, I just use it. I was reading a document earlier on Adobe, and it comes up with this: would you like AI to summarize it for you? So I said yes, please, because I was interested to see what it came up with. It came up with a summary, but it wasn't a particularly useful summary. And in some sense, it was a very naive summary.
Yeah.
And the main purchasers of NVIDIA's chips are the people who provide AI services. And I just don't think that the AI service being provided, and obviously, but I just don't feel that the AI services being provided are actually going to meet expectations. So I do think that, as you said before, Keith, with the advent of the internet and so forth, this is a bubble that will pop, and then gradually the winners, the technology that's going to come out of this will show us the real long-term winners.
Yeah, I agree. And actually next week, we'll be doing a special section on AI, because I will dissect the Goldman Sachs report on AI. And Nero Rubini was making this point. But there's another Goldman Sachs analyst was basically very skeptical about AI, because he was saying all the other big tech innovations have been very cheap. And the point about AI is it's astonishingly expensive.
Yeah. And at some point, the consumer has to be willing to pay for it.
Yeah.
And currently, the big tech companies are footing the bill.
Yes, that's right.
There we are. Most of the returns of the S&P 500 due to the top 5, which we sort of know.
Yeah.
And falling interest rates expectations have been historically, and one would expect should still be, good for small caps and their reliance on loan funding, but also on just basically the comparison between the dividend you can get with a small cap and the money you get from putting it, the interest you get from putting your money in a bank.
Yeah, agreed.
And the CTAs, commodity trading advisors, are fully committed to the equity market.
Yeah. So this, we can see why it's corrected so sharply.
Yeah.
Everyone was long, as we were saying.
And it shows that the valuations, whilst they are stretched, they're not as extreme as they have been and as they were in the tech bubble.
Yeah.
These are Hindenburg omens, which is supposed to be an omen of a stock market crash, and they occur really quite regularly.
Well, we showed this a couple of weeks ago, and it was dead right. So there you go. Believe in nonsense, Richard.
With a Hindenburg omen, surely it's something totally cataclysmic.
Yeah, well.
So this shows that in the last 20 years, around 20% of the S&P 500 stocks lost money, while the average stock rose by 390%, the median by 93%. So you need to, if you want to get the big winners, if you want to get the big returns, you need to pick. You need to stock pick.
Yeah, and then you need to cut the losers, basically. Simple as that.
Yeah.
But all this, so all this presupposes that, buying and selling, that you don't pay enormous capital gains tax bills. And, What I'm interested to see what Rachel Reeves does. If she raises capital gains tax, because she's ruled out raising income tax, if she raises capital gains tax to, let's say, 30%, then mucking around in equities just doesn't work anymore. Because if you have to buy and sell them outside of a wrapper, it's painful.
Yeah,
so
you have to do it within your ISA or SIP.
Yeah, absolutely.
And hedge fund positioning accounts for a lot of the changes in the last couple of weeks, where they have gone from not being that far off, being heavily long to heavily short.
Yeah. So that rise in the Russell 2000, a lot of those are quite illiquid companies. So, big capital movements have driven the price up of small caps and, obviously tech companies down. But it's not clear to me that the share price rise in Russells is driven by fundamentals as yet.
Yeah. Tesla shares fell 12.6% after the Q2 results, and earnings per share fell 47% year on year. Chunky drop.
That is a huge drop. And Tesla, how many times we talked about it? It's an idiotic company. I mean, it's like just doesn't, it just comes up with nonsense every quarter to try and keep people buying. And now he wants to move the company to Texas so he can get a $46 billion pay rise. It's just idiotic. Thank you, Richard. On to commodities. So sharp falls across the board. I'll take you through the data, but oil fell sharply. Natural gas actually in Europe was immune from the falls. Industrial metals, really sharp falls. And that was echoed in precious metals as well, particularly for silver, platinum, palladium. So looking at energy, oil down 4%. It's actually recovered in the last couple of days due to the strong GDP numbers in the US, but fears over global demand is the commentary. WTI down 6%. And looking at numbers for the oil market, then these are changes in inventories. All the data is the last 2 weeks, not last week. But again, you'll see increasing inventories in the US. The US market is oversupplied, and that's despite the Baker Hughes rig count continuing to fall. US oil production is stable at its highs for the year, 13.3 million barrels a day, biggest oil producer in the world. And while we talk about oil, so Venezuela is holding elections this Sunday, and we talked about Argentina earlier and how populism is a disaster for a country. Well, 25 years ago, Venezuela voted in a populist socialist, Hugo Chavez, who immediately basically took over parliament, installed a socialist regime. It's nominally democracy, but all the elections are deeply corrupt. You can see the effect of socialism on GDP and oil production. So they put generals in charge instead of people with any commercial nous, and deep corruption. Venezuela's oil production fell from 2.7 million barrels a day to 0.7. Now, all the polls are that the opposition should win by a margin of 20 to 30%, so absolutely enormous. But socialists have the guns, and will they allow a transition to a new democratic government? Watch this space. If they do, then the new president, so the candidate for the presidency, she has been talking about how she would immediately privatize the oil industry. And Venezuela has the largest oil reserves in the world. And private capital, you could see Venezuelan oil production going straight back to 3 million barrels a day. It would take a while, it'd take 5 years, but that'd be a big rise. So Venezuela matters for the world oil industry. let's see what happens this Sunday. EU natural gas prices actually ticked up over the last couple of weeks, going nowhere. We've had the fall, sadly. UK natural gas prices also stable. US natural gas prices back down towards their lows, down 20% on the year. Coal ticking up, still down 5% on the year. Uranium drifting off, down 10% on the year. On to industrial metals, Richard.
Thanks, Keith. So aluminium, big fall, nearly 8%, down 5% year to date. Cobalt has stepped down some more, down 9%, nearly 9% for the year. Copper, another big fall, down nearly 10% over the last period of time, still up 5% year on year, but a lot of that, most of that big run up has been reversed. Chinese copper stockpile. So this is Chinese copper exports have surged with the result of weak domestic demand, and perhaps they're trying to sell off, perhaps they're selling off some of their stockpile.
Yeah.
And that's a big change, isn't it? From
Yeah. So do you think, so looking at this, Dr. Copper is diagnosing a weakening world economy. Do you think the general falls in commodity prices are a harbinger for weakening world economy?
So I think there may be, but I'm dubious that copper is, because I think demand for copper has to increase with electrification that's going on. So I think basically copper probably just got a bit ahead of itself. There is at the moment, there's plenty of copper. They're forecast to be supply shortages and deficits within the market in the next few years. So I think about, say, aluminium. Aluminium isn't particularly used in electrical production, electrical transmission. Obviously, it's used in engineering and construction. So I suspect that everything's been hit by the same sort of risk-off approach, but the copper, I suspect, is going to bounce. It's going to go back up and continue. Whereas it's not aluminium. I don't think there's, you know. And let's have a look at some of the other industrial commodities, Keith.
Actually, before we do that, Richard, well, the thing I'd say about commodity demand in general is that we've had, over the last 20 years, this enormous surge in demand from China, driven by just absolutely extraordinary investment in property, for example, copper pipes. And if China is now suffering the bursting of its property bubble and is going to systematically invest less in new homes going forward, you could see actually the extraordinary demand being lower going forward than it has been previously.
I completely agree, Keith. You can. And it's hard to know how that's going to interact with the increasing demand for conductive material. Very difficult to know.
Yeah.
So chromium, unchanged. Iron ore down a little bit, but actually down 25% year to date.
Yeah.
Back to its last September levels. Lithium down 11% year to date and 5% for the last 2 weeks.
But look at it over the last year, down 2/3.
Yeah, so I think the problem with lithium is that the much vaunted demand for all electric cars is being reassessed, isn't it? Because the charging capacity isn't. The main problem really is the charging capacity isn't available.
Yeah, but also, Richard, we talked about this, last year and year before. People just hadn't been looking for lithium because it wasn't very useful. And now, they've started looking for it. And there's that extinct volcano in Kansas or somewhere. They've discovered that, 6 times world existing reserves. The moment you go looking for it, there's plenty of it.
Yeah, that's right. And there's been, although that hasn't been mined yet, the actual demand, the anticipated demand isn't coming through, I guess. Neodymium has been pretty flat recently, down 18% year on year, or year to date, and nickel down 5%, but not very much down on the whole year. But obviously, that had a big run up, a big run down again. I think the commodity markets just got frothy, didn't they? I mean, they're all showing the same shape, which is basically back to where they were at the start of the year.
Well, we're talking about nickel because nickel's just incomprehensible, the run up, because we know a wall of supplies coming from Indonesia the coming year. So why on earth would it, go up by 50%? It was weird.
Speculation, I guess. Speculators. Tin down 13% on the week, still up 16% on the year. And zinc down 9%, leaving it unchanged for the year.
Yeah. So general big weakness in the last couple of weeks in commodities. Really quite shocking, actually, quite shocking falls.
Yeah.
Is that just risk off and speculators, taking money off the table? We just don't know yet, but
I agree with your point about China. I think the interaction with copper is very difficult to understand. I think it's bound to affect demand for steel negatively. I suspect it'll affect demand for aluminium negatively. And so there's that a huge uncertainty surrounding it. So it's very difficult to tease it out from speculation from actual supply and demand, isn't it? So having a look at precious metals. So basically gold has been flat now, give or take, or in a range for the last 3 months, and still up 15% year to date. And this is what happens to gold when the Fed cuts rates. Gold tends to respond well to the cutting of interest rates. So the Fed is expected to start cutting interest rates. So in that case, it should be good for gold. But of course, actually, the Fed raising interest rates has been good for gold this time around.
Yeah, no, amazing. But I would also warn, though, that when you look at like 2008, yes, gold rose strongly over the period, but in between there was a 30% drop during the GFC. So volatile.
It is very volatile, definitely. Chinese gold imports fell to the lowest level from 2002. Is that what's going on there? I mean, they weren't particularly high in January 2003. They've been very high the first part of this year. I think we need more than 1 month's data to know exactly what's happening here.
Yeah, but also it may just be that Chinese economy is not doing very well.
Yeah. And gold, actually, it's a bit of a canard that gold falls when interest rates rise. If you look back over 50 or 70 years of history, but there's this one occasion in 2000 and around about the GFC where it did happen, but it hasn't really happened historically.
Really? Yeah. Well, it certainly hasn't happened this time.
No. There's miners to gold ratio, which suggests that if the miners break above that downward line, then they are going to rise quite substantially. And
really?
Yeah.
I'm
well, the point is, see that if you're currently a gold mining company, gold is basically at an all-time high. Let's call it $24. Your pricing, much of your price input is energy, and the price of oil hasn't really changed very much. It's not subdued. So you've got this huge incremental return of several $100s on every ounce of gold that you produce, which goes straight to the bottom line. Yeah. So they are going to start throwing off large profits.
I'm skeptical, Richard. I think it's better to own gold than miners.
Well, I think, I mean, we'll see, won't we, Keith? But that's the logic behind investing in gold miners at the moment.
That's true, but miners have seen a 20% increase in their costs over the last couple of years. Gold has gone up, but has it gone up 20%? Actually, it's gone up 15% this year, so it probably has. But
silver's down 10% over the last couple of weeks, but up 14% year to date.
Yeah,
very volatile. Platinum is back below where it was at the start of the year now. Rhodium hasn't really changed very much recently.
Dead as a dodo.
Yeah. Palladium, it's having a bad year, isn't it? Down 26%.
Yeah.
Down 8% for the week.
Thank you, Richard. On to rates, and super bad. So I would have expected a sell-off in equity markets to lead to safe haven buying in the form of government bonds, but actually the opposite happened. Long bonds fell, meaning the long yields rose as the equity market fell. So it seems that currently long bonds are perceived as risky, and you can see the black line is the UK yield curve, and over the past year, although short-term rate expectations have fallen, long-term rate expectations have risen. So terrible for me, exactly the opposite of what I was expecting. And what that means is real long-term rates have risen, or that central banks have lost credibility in their fight against inflation. Now, all the data we've seen on consumer expectations for inflation show that that is not true. So, not really sure what's going on, but investors are certainly demanding more yield to hold long-dated bonds. Now, in the long term, medium term, the interest rates that an economy can support are a function of productivity. And unless the economy has become more productive, which I don't think it has, then real yields should revert back to what they were pre-pandemic, I would have thought, or they're long term. And so they shouldn't really rise further from here, and hopefully they should fall. But so far, it's been a terrible trade. So the same has happened in the US. You see that long bond yields have risen sharply over the last year. Now, I showed this earlier, but 20-year plus US Treasuries, their price has risen above the 200-day moving average. Will that mean finally they start to catch a bid? Let's see. China, though, continues to sell US Treasuries, buy gold, amongst other things. And, bonds are meant to do well when equities fall. And that was certainly the case over the last 20 years. But actually, since inflation has risen, the opposite has occurred. So stocks and bonds no longer diversify each other. And that means the 60-40 portfolio doesn't really work anymore. They're both risk assets. And we've certainly seen that this week. And the US market sees US interest rates at about 4.1% in 12 months' time. So forecasting just over 4 interest rate cuts over that period, i.e. no recession. And medium term, no recession and interest rates that bottom about 3.5%. So, US running a big fiscal deficit, that continues, then rates stay high, assuming there's no recession. But liquidity in the Treasury market is very poor, and that means volatility. UK yields have now risen above US ones, having been below them for many years. So the UK, what's killed me is I'm very long UK bonds, and UK bonds have been doing exceptionally badly. You'll see that they've been rising at a time when US 30-year is stable. German ones have definitely peaked. UK very much towards their peaks. And so the market appears to be charging a premium now to lend the UK money long term So the market is skeptical about UK inflation. This is a UK 2-year, come right down, but 10-year, it hasn't. So the market is saying that they don't think the Bank of England will be able to cut rates below 4.2% on average in the next 10 years. I think that's wrong. And the 30-year, appalling, just rising again towards its highs for the year, 4.8%. Terrible for me. So not looking very clever. And you'll see this is long-term interest rates. In order for my trade to work, the Bank of England needs to be cutting interest rates hard. So I was expecting higher interest rates in the UK to lead to a recession, and it hasn't. So I'm now stuck in a losing trade, frankly. But medium term, I'm expecting UK long bond yields to revert to somewhere they were pre-pandemic. I mean, productivity in the UK is still absolutely appalling. And if we can get inflation under control, then yields should start to come down, he says. But so far, this trade has been a total disaster. So this is the US 10-year coming down in a way. The UK 10-year is not coming down. German bond yield, well down from its peaks. French, no, actually, you'd say that is no sign that it's systematically coming down. Italian, that looks good. Greek, that looks good. So concluding comments, well, sharp falls in all asset markets this week. Commodities, equities, long bonds. It is too early to say with the start of a bear market. Are commodity markets seeing a slowdown in the global economy? Let's see what happens from here. Richard, how have you been?
Yeah, obviously the precious metals sort of flattened down a bit at the moment, so that has a little bit of a downward effect on my portfolio. I haven't done anything, I haven't changed any of my positions, and I'm just sitting on my hands. So nothing to report really. How about you, Keith?
Terrible, really bad. Down another 1.2% last week, taking me towards the lows of the year, and we're losing money again today. Not much fun. Got this totally wrong, but I just don't see medium term how the UK can support, if we get inflation under control, and I think we are, but, if Rachel Reeves raises public sector pay by 5.5%, then the Bank of England just has to keep rates higher for longer, is the bottom line.
Yeah.
But eventually, I think inflation does come under control, and that should mean that bonds start to perform. But so far, I've been totally wrong. Now, recessions, in order for this trade to really pay off, we need a recession. And as we've gone through the data, there's no sign of that. But recessions can occur relatively quickly if you get a feedback loop forming. And in particular, if there's a sell-off in equity markets, then you get that feedback loop starting. So we've had this bubble in AI stocks, and I think it has been a bubble. I mean, Nvidia aside, Nvidia's done incredibly well on real revenues, but there's been a lot of investment in AI, and I'm skeptical it will pay off. So let's see what happens in equity markets. But my call has been absolutely terrible so far.
Yeah.
So not much fun, very stressful actually. And medium term, if I just hold on to these, I will be fine. After adjusting for capital gains tax, etc., all of which is index-linked gilts are exempt from, then getting 4.5% per annum tax-free, that's great actually. That's fine. But right now I've lost 10% this year, and I can't afford to do that again. But I can't see them using another 10% next year.
No.
So not much fun. And, what I've got completely wrong is that, I think the stock market should follow the economy, but investors have been buying the stock market for the last 2 years, even though the economy's been doing really badly.
Yeah.
And, this is indicative, buying conditions in the US. We've been talking about, house prices, etc. Are absolutely the worst they've ever been. But the S&P house builders through the roof, So my kind of worldview has been just wrong,
Yeah.
So, it's been painful, the gilts trade. But I'm now going to go away on holiday and try not to look at my phone 3 times a day. So thank you all very much for watching. It is goodbye from Richard Wheater.
And it's goodbye from Keith Jordan.
Goodbye.
Goodbye. Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.